What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey. Joining the podcast this week is my colleague Stephen Gregory, who heads up the quantitative research team at Piper Sandler.
Michael, good to see you. You've been on the road a ton lately. I think you've been 3 weeks in a row now out seeing clients.
Yeah, I've been traveling the world. I was in Europe a few weeks ago visiting clients here. Get this, in 4.5 days, I managed to go to, I think, 6 cities: London, Paris, Frankfurt, Milan, Geneva, and Zurich. How many is that? 4, 5, 6?
Oh, I wasn't counting, but a lot. It was a lot.
Yeah. It was one day. I was in 3 countries and 3 cities in one day. So yeah, seeing clients, crossing borders. The sentiment, though, this was 3 weeks ago. So the sentiment in the market was just starting to turn. In Europe, there's definitely been a more, I don't want to say bearish mindset, but certainly on a relative basis, not as optimistic as U.S. investors have been. Much more concern of the deficit, much more concern of interest rates moving higher. And I think part of that is just the European mindset. It's very different from the typical American investor because of the more global nature that those folks are used to. And they actually usually have to follow fiscal constraints, which, in the US, obviously, there's much more leniency that the US gets given its reserve status and just broad-based economic domination. But yeah, concern around employment was certainly a topic there. And then the week after that, I was visiting clients in Minneapolis and Boston, and concerns there are, again, whether or not the Fed was going to cut December. And then last week, I was in the West Coast in Los Angeles and San Francisco, where the markets were really under pressure. And we were at a dinner with about 25 or so CIOs and senior portfolio managers. And it was just so fascinating to hear how quickly the sentiment, or see how quickly sentiment can turn. I remember, as I'm sure you do, the markets back in July and August, and the sentiment then was nothing's going to take this market down. Or what's that old Chumbawamba song? I get knocked down, I get back up again. And
Yes.
a couple of months later, the glass is now half empty for sure. And a lot of concern around the K-shaped economy. Man, we've been talking about a bifurcated K-shaped backdrop for years. And it's like all of a sudden the Main Street media can't get enough of that story.
I was reading an article this morning talking about explaining the K-shaped economy.
Yeah.
While you were out globetrotting the world, a lot has changed in terms of sentiment in the last 3 weeks. You've had Bitcoin pull back significantly. Beta breadth has the way bullish sentiment has changed. It's hard to believe that we are only 4% and change off the highs, but there's been a major shift.
Yeah. And there are certainly a lot of stocks that you could add a zero to that, down 40, 50%. And those are many of the stocks that were going up 40 and 50% this summer. And yeah, it's always, the index is never a great representation, especially nowadays with the concentration of the market, of what's going on in the market. It's interesting because this whole idea of the K-shaped economy, to me, also means you have to be careful about taking specific data points and applying it to the whole. I mean, like, everyone is very much on board with the backdrop being K-shaped, but then taking a data point that's really weak in the lower part of the K and saying the whole economy is really bad. And to me, that's a concern. We may see the weakness spill over, but I think it's important to acknowledge that in a K-shaped backdrop, you have to be careful about cherry picking really negative data points and applying it to the whole. That's an inconsistent way of thinking about it, in my opinion, but it certainly leads to a lot of debate for sure.
Speaking of picking one data point, you've seen a lot and read a lot about Bitcoin and its pullback and it being a harbinger of bearishness and the economy's tanking. I know you have some interesting thoughts on that. Do you want to talk a little bit about Bitcoin? Not something we typically talk a ton about in the work.
Yeah, let's talk about crypto. And I always enjoy jumping on X every once in a while into some of these Bitcoin spaces just to hear sentiment and get a sense of what people are talking about. And what's really interesting about Bitcoin, and this is perhaps unique to crypto, is there's there's so many narratives that are Bitcoin or crypto specific. And these Bitcoin maxis, like they're called, are always rationalizing what Bitcoin is doing by something that is specific to crypto. And whether it's the halving cycle or some seasonality or some fiscal policy related to crypto, which obviously there's been a bunch of in the Trump administration. However, I always like to try to quantify things. That's the thing that's tough about narratives. Sometimes you can't really quantify them. But when I look at Bitcoin for as an example, I've seen, we've written about this a little bit in our work over the years, that Bitcoin is increasingly correlated as it's matured with other financial market measures of risk like credit spreads. We often hear people say Bitcoin, it looks like the NASDAQ, or Bitcoin looks like AI stocks. And the connection there is that Bitcoin, the NASDAQ, crypto related equities, AI related equities, one thing that ties them all together is just general broad macro and market risk, which I think credit spreads is a good reflection of that, or a good way to quantify that idea. And so when you look back over the last 4 or 5 years, all of the material drawdowns in Bitcoin have also occurred alongside periods where credit spreads were widening, equity market breadth was deteriorating, and there was a general risk off sentiment. From my seat, I'm trying to understand what is driving crypto. And again, I hear all these narratives about specific things related to crypto, but I also can very much visibly see, and it seems more than reasonable, that if there's general risk off sentiment in the financial markets, a higher beta asset, especially one that has no earnings or yield, typically gets hit the hardest and also tends to rebound the most when things start to look more rosy. So yeah, it'll be interesting to see if we ever see Bitcoin break apart from that relationship of credit spreads. And can Bitcoin rally at a time where there's general risk off market sentiment? I don't believe we've seen that. But until we do, I'm going to continue to believe what I see, which is that Bitcoin is just a hyper risk asset, and it's not where you want to be when macro risks are starting to get priced into equities. And I think that's been part of the explanation of the explanation for the big drawdown in Bitcoin and crypto. And it's quantum stocks, it's tech stocks with no earnings. So again, it's all the stuff that was doing great in July and August when the markets were ripping and stocks with no earnings were going up the most. And so if we think about why is that happening, one of the explanations for the market's weakness in the last month or so has been the angst around whether or not the Fed's going to cut in December. And so a chart I put together last week was just highlighting the percent odds of a cut in December and plotting that with the market. And it's been a pretty good relationship or explanatory variable. As odds of a cut for December went down, the market's been under pressure. The coin kind of correlates with that too. And then Friday, of course, we did see, I think it was Williams, say something more dovish and got the market back up. Odds of a December rate cut are, I think, now back to around 60. So it's very much still a high possibility. If I had to pick a side, I would say there's still a very good likelihood the Fed does cut in December. One of the data points that we'll be getting in early December before the Fed's meeting is the job openings data, or JOLTS, which we've not seen that data in at least over a month now because of the shutdown. And when you look at some of the other data, like Indeed job openings, that's been continuing to generally decline, which points to a softer JOLTS number, which to me is a bullish data point for both equities and bonds and increases the likelihood that the Fed's going to cut. And just when we think about Powell, aside from inflation, job openings is the phrase that he's probably used more than any other.
So if we can continue to see measured weakness in jobs, keeps the Fed at bay, keeps rate cuts on the table, continues the general better backdrop for equities.
Yeah, I think so. That's been our theme for the last couple of years. As long as it's controlled, there's no big negative shocks to employment, which I don't see many negative macro impulses that would cause the spike in unemployment once it starts to rise. And some of the things you look back historically that coincided with that is looking at oil prices. Back in early '07 through mid '08, oil was going vertical. And I remember oil at $90, I believe, in '07, and ultimately got up to, I think, $147 by mid '08. I remember that very well because some long-term bears on oil turned bullish that same week in mid-July of '08. We won't name any names, but those things tend to happen. So we don't have oil prices that are a real problem. The Fed has obviously been cutting for over a year now. Mortgage rates continue to drift lower. The long end continues to drift lower. So to me, I see it as a bit of a tug of war, or no pain, no gain, or kind of zero-sum game between softer employment. And the silver lining of that is that it is providing for lower rates, which will certainly help other parts of the economy. And it's, I guess, this race between how much employment needs to soften to get rates down to start to produce incrementally better data in housing and manufacturing and transportation, which we're definitely starting to see some of that better data. And I think that can continue into 2026. There's this view that unemployment rising is just a flat out negative, that it's this binary situation. It's either the lights are on, the lights are off. And that's certainly not true historically. There's a lot of gray, and employment's pain is other parts of the economy's gain. That's how I'm thinking about it. And I think that's how the markets are seeing it, because we've seen 2.5 years now of rising unemployment and rising stock prices. Of course, AI is part of that, but doesn't explain why so many other parts of the market are up as well.
Yeah, and that goes to your HOPE framework: housing, orders, profits, and employment, which has been very range bound over the last couple of years. And this year now plus of Fed rate cuts and easing environment, we are starting to see the early green shoots of the beginning of the economic train, the housing, the orders.
Yeah, the data that I think people should really have on their radar is mortgage purchase applications. It's the high frequency data for the housing sector. Every Wednesday, the MBA, the Mortgage Bankers Association, publishes how many applications for mortgages there were, how many refis took place. And that data has been improving this year. And while it remains still very low on historical standards, it's going in the right direction. And that's what matters to markets. It's not how strong or weak things are. It's, are they getting stronger or are they getting weaker? I think that's a really important point, because what I'm hearing from clients in the last few weeks is concern around the weakness of areas of the economy. But at the same time, they're acknowledging in some pockets, they're seeing things incrementally get better. So that's where the best returns tend to show up. And that's where rotations tend to take place, is when your sentiment is so lopsided on either the bullish or bearish side, and things start to slowly and incrementally turn for the better or for the worse.
And it's that data that sets up the economic cycle in the year ahead, as opposed to, say, a huge pullback in the markets in April that feeds a beta rally. You're talking about the bigger picture and the longer term and the investment backdrop for the year plus ahead.
Yeah, absolutely. And there's, again, many periods in today's context, thinking about housing and employment. There are many periods, really '07 and '08 is the exception, where as unemployment went up, housing got increasingly worse. And we generally know why that happened, and why those conditions aren't the same today, and why we're not seeing that today. But if you look back at other periods where unemployment was rising in the early '90s, even in the very mild recession of 2001, you are seeing what you saw back then is the same thing you're seeing now, is employment is weakening, and you're seeing more people actually start to apply for mortgages. Again, sometimes the market can go down like it did in 1990, even though that's happening because the Persian Gulf was invaded and oil spiked from $15 to $40, or you had a far more egregious bubble back in the 2000 period than we do today, and those stocks got hit really hard. But again, even in '01, underneath the surface, there were many stocks that went up a lot. Value stocks did really well. Small cap stocks did really well. Financial stocks did really well. Of course, we had 9/11 towards the end of the year, which obviously reshaped things. But yeah, there's no hard and fast rule when it comes to macro and markets. And while it's really fun, I saw somebody on Twitter had built a analog creation machine, basically, where you could put in today's market and it would go through history and line up the most correlated period in the past of the market. So basically you could say today's market looks closest to the mid 90s. And again, that's, I think, interesting. And perhaps there is some insights in there, but we're not in the mid 90s. The context of today's backdrop really is going to overwhelm any analog of the past, getting that into that much minutia.
That's a fun idea. I'm surprised we haven't thought to do that.
Yeah, I think part of it is, again, while those are interesting,
but not practical.
Yeah, and everything looks identical until it breaks down. Like, for example, for many years, there was a big argument that the Fed's balance sheet is the only thing that's driving the market. Now we don't hear that at all because they've disconnected for the last 4 or 5 years. Again, analogs are interesting, but if you don't know what the connection is and you're just relying on a correlation, you're going to have no clue when they break down and why they break down or what the risks of that are. I think that's super important. That's what we try to focus on, is looking for similarities of behavior or fundamentals of the past, but then again, understanding what are the differences and how they could be different going forward.
That's our secret sauce, the why. So very interesting. Keeping an eye on housing, mortgage applications, and hopefully that continues to set us up for a better 2026.
Yeah, I think whether or not the Fed cuts in December is going to have a big influence on how we end the year, if not the biggest influence. And again, we'll get that JOLTS data in the first week of December. We're not going to get the next employment data or inflation data, I think, until after the Fed's meeting. So maybe the Fed should push back their meeting a couple of days. I'm not sure how much flexibility they have around that, but it wouldn't be necessarily a bad thing. Yeah, that. And then we had a pretty good earnings season. I don't see much of a reason from a broad perspective that earnings are going to be a real headwind to sentiment going forward. It's really about where are rates going, which, has been where we've been focused, and where's employment going. And I thought this most recent employment report was okay for the markets. The unemployment rate ticked up, which is probably one of the more reliable parts of the employment report. The payrolls number was positive, but it'll get revised. The prior month got revised into negative territory. But again, if people should look throughout history, and what they will find is that when unemployment goes up, the markets actually oftentimes do well. You just have to go back through history a little deeper. And historically, when rates are falling and housing data is incrementally improving, that tends to be a good backdrop for markets. Higher unemployment is not necessarily the end all be all. You have to think broader. And that's where a hope cycle really helps out, because if we're getting better housing data and PMI data are improving, and one of our views is the ISM manufacturing index is going to get back into expansion territory next year. If the unemployment data is moving higher, but also housing and orders data are stable or improving, historically, that's a bullish backdrop for equities. So we'll see if that is the story for 2026.
Great, Michael. Thank you. And welcome back. It's good to see you again here back in the New York area.
Yeah. And a happy Thanksgiving to everybody. One of the things I like about my HOPE framework is that it's really simple. It doesn't overcomplicate the economic picture. And so when thinking about Thanksgiving, last year, we usually host, and I usually cook the turkey, and I've done deep fry. I've done it in the oven. And the best turkey I've ever had was the one I made last year. And that's from feedback from our guests, is the simplest recipe out there. It's a New York Times recipe. It's basically, you buy the turkey a few days ahead, you salt the heck out of it, you stick it in the fridge, open air, not wrapped up. You let it dry brine for 3 days or so. You slap some butter and herbs on it before you throw it in the oven. And that was the best turkey I've ever had. It's so juicy. So I'm going to do that again this year. And again, the beauty of it, just like our HOPE framework, is that it's very simple. So no need to overcomplicate things to make them better. Keep it simple.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.